Charlie Cardona, there's a lot of flux right now in the money market space because of government reforms, which are hitting this week. So let's start off by talking about what these reforms were meant to solve.
These reforms were really meant to solve some of the challenges that we all faced back in 2008 during the financial crisis. And money market funds were certainly in the middle of that, particularly around liquidity issues where liquidity in the market was not available and things were very hard to sell. So the reforms were really designed for two things. For institutional investors who redeemed very heavily out of institutional prime money market funds in 2008, for them to see that these products will actually fluctuate in price, and we now have to do that starting this Friday. And we also have to adopt policies and procedures around implementing redemption gates in the event of a run on a fund. And that's exactly what they are intended to address and hopefully solve.
All right, so how will these reforms affect prime funds, which are corporate bonds, short term? Talk about the pros and the cons.
Biggest impact on the prime funds, not a lot of pros versus what we had in my personal opinion, because institutional prime funds and institutional municipal funds must now price out to 4 decimal points, so there will be price movement every day. There could be a small gain or loss anytime an investor processes an order. And we have to adopt policies and procedures around fees and gates, and we have to carry mandated liquidity levels and a lot more disclosure. That's good news. The disclosure is good news for investors. They should have that. We have been a proponent of that at Dreyfus for many years. We were the very first to actually post our prime fund portfolio every day back in 2007 because we believe that investors should know what they own and, as importantly, what they don't own. So the good news about reform is certainly the disclosure. The bad news was a bit of overkill on both fluctuating price and fees and gates.
Well, a lot of that overkill is causing dislocations across all three forms of money markets. Let's talk about the munis now, because you're seeing a lot of dislocation there. Talk about how these reforms are going to affect ultra-short muni funds and muni money markets.
Sure. Muni money market funds have had severe dislocation because of reform. Institutional prime funds in the municipal sector must now fluctuate in price to 4 decimal points, and must adopt policies and procedures around fees and gates. So a lot of investors lost the convenience that they liked and have moved to different products. That has created disruption to issuers who can find demand for the supply, and to investors who don't have the product that they like, and it even affects retail muni funds because they must adopt, fees and gates. Conversely, what you've seen is that you now have very attractive rates in the muni sector today. So even excluding the tax calculation you would make around the tax sensitivity, and is it a better investment, it's got a higher gross yield. So demand is holding up there, but it's very disrupted right now.
And then finally, what's going on with regard to government funds? You saw a lot of money move from the prime to the government over the course of this, implementing these regulations. How do you see that going forward?
The shift has just been huge, and certainly up to the higher end of our estimates and the industry estimates. Over $1 trillion in the past 12 months has moved from prime or institutional municipal to the government and treasury sector. So they've been the biggest beneficiary. Government and treasury funds now make up 80% plus of the $2.5 trillion that's invested in 2A7 money market funds. I think that prime funds are at their lowest point we've seen in 20 years. I think they could stay there for a while, but my belief is they will eventually recover as people see that the regulations aren't quite as disruptive as they feared that might be.
All right, and then finally, what's the big takeaway for the retail investor, the average investor out there? What should they be thinking about when they hear about all these changes in their money markets?
Retail investors should really take advantage of the disclosures and the information that providers are giving them today around liquidity, and they should focus on what the rules and regulations mean, and as importantly, don't mean. So retail investors can still use a product that prices at $1 using amortized costs, so it won't fluctuate in price. The retail market behaved very well in 2008. There was no run on the retail money market funds. There was no run on municipal funds. Retail investors should continue to be comfortable, but should take advantage of a lot more information that they didn't have in the past.
All right, well, thanks a lot, Charlie.
Thank you. Pleasure.
And thank you for watching The Street.